A credit card is a financial tool that allows consumers to borrow money from a bank or financial institution for the purpose of making purchases. When using a credit card, the cardholder can charge items to the card, up to a certain credit limit, and then repay the borrowed amount plus interest over time. Credit cards come with various fees and charges, such as annual fees, interest rates, and late payment fees, which vary depending on the issuer and the specific card. They also often offer rewards programs, which can provide cash back, points, or other perks for using the card for purchases. Credit cards can be a convenient and flexible way to manage expenses and build credit, but they can also be a source of debt if not used responsibly. It's important to understand the terms and conditions of a credit card before applying for one, and to use it wisely to avoid falling into debt. There are several types of credit cards available in the market. Each type of credit card has its own features and benefits. Here are some of the most common types of credit cards. Rewards credit cards. These cards offer rewards such as cash back, points, or miles for every purchase made using the card. Cardholders can redeem these rewards for travel, merchandise, or statement credits. Travel credit cards. These cards offer rewards and perks specifically designed for travelers, such as airport lounge access, free checked bags, travel insurance, and other benefits. Balance transfer credit cards. These cards offer a low or 0% introductory interest rate for a specific period, usually 6 to 12 months, on balance transfers from other credit cards. This can help cardholders pay off high-interest debt faster. Secured credit cards. These cards require a security deposit, which serves as collateral for the credit limit. They are designed for people with poor or limited credit history and can help improve credit scores over time. Student credit cards. These cards are designed for college students with little or no credit history. They often have lower credit limits and may offer rewards for good grades or on-time payments. Business credit cards. These cards are designed for small business owners and offer features such as expense tracking, employee cards, and rewards tailored to business spending. Cashback credit cards. These cards offer a percentage of cashback on eligible purchases, which can be redeemed as statement credits, checks, or direct deposits. Low-interest credit cards. These cards offer a low ongoing interest rate, which can be beneficial for carrying a balance over time. It's important to choose the right type of credit card based on individual spending habits, financial goals, and credit history. Reading the terms and conditions of the credit card agreement is also essential to understand the fees, interest rates, rewards, and other features of the card. A credit score is a 3-digit number that reflects a person's creditworthiness and likelihood of repaying debt on time. Credit scores are based on a person's credit report, which includes information about their credit accounts, payment history, and other financial activities. Credit scores are calculated by credit bureaus or credit reporting agencies using mathematical algorithms that consider various factors such as payment history, credit utilization, length of credit history, credit mix, and recent credit inquiries. The most widely used credit scoring models are the FICO score and the Vantage score. Credit scores typically range from 300 to 850, with higher scores indicating better creditworthiness and lower risk for lenders. Generally, a score of 700 or above is considered good, while a score below 600 may make it difficult to obtain credit or qualify for loans with favorable terms. Lenders, banks, credit card companies, and other financial institutions use credit scores to assess the risk of lending money to someone and to determine interest rates, credit limits, and other terms for credit accounts. Maintaining a good credit score is important for obtaining credit, securing loans, and achieving financial goals. Here are the factors that typically go into calculating credit scores. Payment history, 35%. This is the most important factor in determining a credit score. It reflects whether a person has made on-time payments on credit accounts, including credit cards, loans, and mortgages. Credit utilization, 30%. This refers to the amount of credit a person is using compared to their total credit limit. Using a high percentage of available credit can negatively impact credit scores. Length of credit history, 15%. This reflects the length of time a person has had credit accounts open. Generally, a longer credit history is viewed as positive. Credit mix, 10%. This refers to the different types of credit accounts a person has, such as credit cards, loans, and mortgages. A diverse mix of credit accounts can be viewed positively. New credit, 10%. This reflects how many new credit accounts a person has opened recently. Opening too many new accounts in a short period of time can negatively impact credit scores. Here are 10 little-known facts about credit cards. Number 1. Credit cards were first issued in the 1950s. The first credit card was issued by Diners Club in 1950. American Express followed soon after, and Visa and MasterCard were created in the 1960s. Number 2. The first credit cards were made of paper. The first credit cards were made of cardboard or paper and had a $300 credit limit. Number 3. The first magnetic stripe credit card was issued in 1969. The magnetic stripe on credit cards was invented by IBM in the 1960s and was first used by American Express in 1969. Number 4. Credit card debt in the U.S. is over $1 trillion. As of 2021, credit card debt in the U.S. is over $1 trillion, with an average credit card debt per household of around $8,000. Number 5. Credit cards have hidden benefits. Many credit cards offer hidden benefits such as extended warranties, purchase protection, and travel insurance. It's important to read the fine print to take advantage of these benefits. Number 6. Credit cards can have high interest rates. Credit cards can have high interest rates, with some cards charging more than 25% APR. It's important to pay off credit card balances in full each month to avoid paying high interest charges. Number 7. Credit cards have rewards and perks. Many credit cards offer rewards and perks such as cashback, travel rewards, and points that can be redeemed for merchandise or services. Number 8. Credit card fraud is a common problem. Credit card fraud is a widespread problem, with millions of people falling victim to credit card fraud each year. It's important to monitor credit card statements and report any suspicious activity. Number 9. Closing a credit card can lower credit scores. Closing a credit card can lower credit scores by reducing the amount of available credit and shortening the length of credit history. Number 10. Credit scores are impacted by credit card use. Credit card use can impact credit scores, with factors such as payment history, credit utilization, and length of credit history all playing a role in determining credit scores. Credit cards can be a useful financial tool when used responsibly. They offer convenience and can help build credit when used properly. However, credit card debt can be a significant burden and can lead to financial problems if not managed properly. It's important to choose credit cards carefully, read the fine print, and make on-time payments to avoid high interest charges and fees. Additionally, monitoring credit card statements for fraudulent activity is crucial to protect against credit card fraud. By using credit cards responsibly, individuals can enjoy the benefits of credit while avoiding the pitfalls of credit card debt. Subscribe the channel for more updates.